Hey everybody, it's Pete. Welcome to today's episode of Stocks for Breakfast. Today is Tuesday, May 19th, 2020. And actually, I could come back to you today and wave with this hand, and you'll see that I am a married man now. My first episode as a married man. We made the best of a tough situation of what's going on in the world and had we did our wedding vows in the backyard, and everything was just as good as it possibly could have been. So first off, I wanted to say thank you for everybody who sent me an email, and especially if you left a comment in one of the most recent videos wishing me well. I just really want to say how much I appreciate it. It meant a lot to me considering the circumstances and my family being up in New York and not being able to come down to Florida. So it felt really good to have everybody wish me best and my new wife. Today's video is going to be interesting. We're going to talk about two topics. We're going to keep it right on target. We're going to talk about first what's on the board back there. We're going to try and implement the board a little bit more. Is should you trade stocks, options, or futures? The three main asset classes. If you trade Forex, don't send me hate mail. We're going to talk about what most people are interested in trading, for lack of a better way of putting it. And we're also going to talk about identifying opportunity and the clarity of that opportunity and whether or not it should be worth your time, and especially whether or not it should be worth your money. Should you actually invest or trade a situation, specifically trading, and whether or not you can recognize an opportunity that is awesome or an opportunity that's like, what were you doing? It's interesting because so many people can identify those opportunities, after the market closes. And that's not what we want to do. We want to be able to identify the opportunity when the market's open, or when you plan on placing the trade, if it happens to be a swing trade or a position trade, something you plan on holding a lot longer than a day trade. The second thing we're going to talk about is whether or not you can actually spot good opportunities, and a crystal clear, easy way to say to yourself, should I be investing? Because remember, the number one job, the number one function that we have, the number one priority, the number one mindset that we need to have going to the market is, does the reward potential justify accepting risk? It needs to come back absolutely, or if it comes back, don't do it, because you'll end up justifying yourself in a position that is not the greatest idea, where you should not have put your money in harm's way before you even put the trade on. And what's funny is there's a quote that I use all the time when I had my trading floor in New York City. People would come to me and they say, Pete, what do you think about this position? And I'd hit them right away. And I would say, if you didn't have it, would you want it? That's a writer down. That's something to put down and keep on your desk on a little Post-it pad, because very often we're in positions where we're like, you have to ask yourself, because you have an emotional attachment to the position. You have this part of you that says, well, now I have to justify it and build an argument in my head for the position because I own it. Or if you sold it short, you sold it, right? That's the worst reason in the world, or the worst way in the world to stay in a position. And there's another part to that too. If you are not sure about a position, if you're no longer, I'm not really 100% on this right now, or maybe even you see a better trade where the situation is just lining up perfectly, which again is something we're going to talk about on the board here. There's nothing wrong with exiting what might be moving away from your A+ trade, getting flat, taking a small profit, maybe reducing your share size, getting back some margin, and then going into the other one. So be flexible be rigid in your rules, be flexible in your decision making, because the market's always fluid. Before I forget, if you really like these videos and you find that they bring value to you, it would mean the world to me if you can click down, give us a thumbs up, and also subscribe. You'll get updates to future videos. If you have something or a comment, a question, or a challenge that you're going through, you can also absolutely leave feedback underneath the video in a comment, and I'll get back to you as soon as I can as well. So anyway, we're going to talk about stocks, options, and/or futures. Obviously, my company is Stock Trading Pro. My boot camp is about stock trading. So we're going to talk about stocks first. The benefits of trading stocks, the number one benefit, in my opinion, is that you can trade partial partial shares, for like very odd lots. I had a brain fart. You could trade odd lots where you can trade multiple positions at the same time, easier than you can in futures. The big thing about that is if I have 5 perfect trades in any given week, you should put them all on at the same time without having any reservations. I just realized my microphone is all the way over there. I hope you can hear that. And you could spread out, you're not spreading out your risk, you're increasing the probabilities to happen faster, because let's say you have to get to 10 trades. You take one trade on Monday, another trade next Monday. It's taking longer for your probabilities to play themselves out. But if you can take 5 100 share positions, for argument's sake, everybody's got different buying power, you're allowing your probabilities to play themselves out faster. So you're spreading out the ideas, but you're actually speeding up the rate at which your edge plays itself out to get to the point where it's delivering that edge. The downside, obviously, of trading stocks is you need enough buying power to trade multiple positions because there's margin allocated to those positions. We talked about it in our coaching program yesterday. I would say that 70% of my trading is stock trading, because there's certain situations where you want to take advantage of how some of these other instruments work. So from a day-to-day, week-to-week perspective, how I'm building working positions, trading in and out of positions, trading around a core position, is stock trading. I don't think anything beats the ability to get in there and trade different sectors and trade different sectors at the same time, trade different stocks that are having a great day, or I should say a tradable day or a tradable week, when the market might be flatlining like it did quite a bit towards the end of March and the end of April and early May, where the market wasn't really trending, really wasn't doing anything, but there were plenty of stocks in play. So stocks in play versus the market, that's a big advantage of trading stocks, because you won't essentially be shutting your business down. With futures, you can now trade E-minis or even micro minis, which I believe was put together to allow more retail traders to have the feeling of trading stocks, to have the same functionality or capabilities of trading stocks, where you can get smaller pieces. But the same problem happens is you can't squeeze water out of a stone if the market's sideways, unless you drop down to the super micro timeframes, which I don't do. Nothing wrong with it. I don't do that. I did it 20 years ago. I find it exhausting. So the futures, though, that the disadvantage is you're not really spreading out and allowing your probabilities to play themselves out. You can trade smaller, but you can't mix it up a little bit. The big advantage of futures, and the number one opportunity for using futures, is leverage. Leverage is great if you have an edge and you have discipline. If you don't have an edge and you don't have discipline, you're going to be separated from your money very quickly. But if you understand what we've been talking about all the time, and you have your A+ trade, and everything works away from your A+ trade, when you have your A+ trade, and when I say everything works away from your A+ trade, means you have to recognize what your A+ trade is, and anything that's not your A+ trade, you have to start to really think about your conviction levels away from that, right? You start getting really weak on the way down. But what if you do have your A+ trade? And what if that A+ trade means, like yesterday, where the market gapped higher, stayed above all the significant levels that we would watch, and then actually slowly trended the rest of the day? So you might call that an A+ trade. Plus, it was pivoting or holding the opening price for over an hour, where you had a really, really super defined risk and directional bias. Those are the situations where leverage, and specifically trading something like the futures, really hits its sweet spot. And that's when I'll jump into futures, because at that point, I could lower my risk area, not my risk profile, because if I get more contracts in the futures market, I'm taking on a little bit additional risk, but it becomes such an easy tape reading exercise, in the sense that if you can really define your stop loss and you say, this is a major support level in the case if you want to buy it, plus the direction is crystal clear and obvious, those are the situations when you would want to use futures, get additional contracts, and hang on to those for those short bursts, whether it's an hour, 2 hours, or a week, because it's really lining up in a big way. That's when you would want to use futures. Now, futures works a little bit different from stocks, but it's similar, where you're just putting up only the margin to buy or hold that contract, and the day, similar to stocks, the day trading versus overnight margins are different as well. So just day trading is a certain margin, usually more, versus holding overnights, where your exposure is a little bit higher. So those are the two situations there. The third situation is, when would I use options? So we got stocks, options, and futures. It's interesting. If you trade or speak to somebody who would consider themselves an options trading guru, an options trading professional, they will tell you that the absolute worst reasons to trade options are the reasons that most people trade options. Most retail traders, let's just say, for argument's sake, which is leverage, cheap, and oh gosh, what's the third one? Leverage, cheap. Oh, and you know your downside. I had a brain fart there for a second. And you know your downside, right? That that you can't lose any more than that. Options traders will tell you that the factor of time to expiration, meaning your trade has to happen in a certain amount of time because option contracts expire, and the implied volatility versus historical volatility, which will affect the cost of that option to get to that time period, really puts you behind the eight ball for those three reasons that most people like to trade options. So I'm not going to get into a whole discussion about learning what's the right price for an option. The simplest way to determine it is not to determine it. The simplest thing to consider is two things. Number one is the guys and girls who are writing those option premiums, who do that for a living, the market makers and specialists. They're smart cookies. They know what they're doing. They have all their algorithms in place to know exactly, based on the volatility of the market, the volatility of the stock. They have a pretty good idea of how to price that up to expiration. So you're not going to compete with them. Number two is using options for a very specific time period where you are not tying up margin like you would do with stocks and futures, in the same way, where you don't necessarily, let's say you want to trade 1,000 shares of the SPY ETF, which is $295 basically at this particular moment. You're not tying up all of that margin, let's say, for the reason that I use it, which would be a swing trade. So I'm kind of letting it out of the bag there. If I'm using options to swing trade, I'm not tying up $150,000 in capital to have 2-to-1 margin to be able to execute 100,000 shares of the SPY to carry as a swing trade. So what I will do, which dramatically decreases the amount of money you need to put up in your account, if I want to hold a swing trading position in a stock for, let's say, a week to 10 days, then I would dip my toes into options, try and get the best price available, which again, we're not going to get into that today, and then be able to hold that position, a put or a call, for a longer period of time without tying up that same amount of money. Plus, and I think this is a big one, and actually something that I learned a long, long time ago, if you want to, in 1994, actually, if you've ever looked at some of Ken Roberts' stuff, he actually got me involved in the markets back in 1994, where let's say you want to hold it longer than, let's say, a week to 10 days. I learned from Ken that you would create a free position. So let's say, for argument's sake, you bought a call here and it moved in your favor. I'll just throw a number out there. It starts at 50 and goes to 60. As it starts to move higher, then you could sell an out-of-the-money call on that option contract against it. So you're limiting your upside, but you're getting back the margin that you put out. Again, very general terms. You're getting back the money that you bought the calls for, and now you have a free trade within that window. Your upside is limited, but most stocks normally move within a certain window. There's the outliers, absolutely, but within that window, you now have profit potential within that window at little to no cost, maybe even just a little bit of cost, and that's why the free trade can work out really well. So that hopefully you'll now evaluate on your own what a free trade could look like as stocks, when you might use futures, and you really need to have a strategy dialed in to know when to use futures and use that leverage, because if you don't, the way it moves, you can really get slapped silly and get stopped out. The thing ends up going nowhere, and you end up losing a lot. I just throw a lot of money without it going anywhere. So if you have your edge and you have a really defined A+ trade, futures are great for those windows of pockets of opportunity. And then stocks, in my opinion, obviously my company, Stock Trading Pro, I feel that is the greatest way to learn, the greatest way to accelerate, allowing your edge to play itself out. And there's no better way, in my opinion, to trade relative strength, relative weakness, and really dig into the again, the pockets of opportunity of super strong or super weak sectors or industries at the same time, where you can even trade one long and one short at the same exact time based on how they're trading, earnings, or however it happens to be. So I love stocks. Equities is my heart and soul. So hopefully you get an idea of what that looks like now, the different opportunities and the different situations you would consider any one of them. And also, I wanted to finish up on knowing when you should be involved. Now, there's a very big thing that I'm kind of crazy about, and that's understanding order flow. And order flow is what goes on over a period of time. And let's consider it at the very least, a month to 3 months to 6 months, because we're trading in that window. We're trading in that trader's window. We're not looking to invest in this particular circumstance to hold something for years. And the concept is I want to keep my money working, right? I want to keep my capital working. If you have a stock that's been in a trading range recently, or you can look at a daily chart and say the stock is stuck between these levels, and the stock has one really good day, you're trading on 1 day's worth of, let's call it 1 day's worth of order flow, which it is. The 1 day of order flow created that uptrend or downtrend that day. In your mind, the simplest way to think about order flow, the simplest way to have conviction in your ideas, the simplest way to stop hesitating and put on a trade immediately is you say to yourself, if I look to the left, how much buying or selling was done by the smart money? How much buying or selling, and how long has that buying and selling been obvious? When the answer comes back, that's going to tell you the conviction level you should have in your ideas. Now, you can absolutely trade a stock that has 1 day's worth of buying or selling, but it's very different, and we're going to end on this. It's very different when you can look to the left and see days, weeks, and even months of that stock going up or down. And I'm going to share my screen really quick to drill this point home. So we're going to take a look at DDOG, which has been a stock that you can see for weeks. We have 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks in a row of well-bid price action. And I'm actually going to put this on the daily chart to really drill it home, versus where we were talking about Honeywell and Goldman Sachs yesterday. So you can see Honeywell, in my opinion, has pretty much been in a trading range. So let's say from the middle of March to even now, we blipped out a couple of times, but keep getting right back into it. So we're really just trading this 1 day's worth of price action, which, by the way, was a really good day yesterday, but not long-term. So you were just basically trading yesterday, which your conviction level could not have been massively high because it's only 1 day, right? It was all boats get lifted when the tide's rising. And the same thing with Goldman Sachs yesterday, where it had an amazing, amazing trend yesterday, intraday. But again, the daily chart looks very similar, where you're just trading that 1 day. So if you can look to the left and say, is it obvious, and how long has it been obvious? That answer will come back very quickly to tell you your conviction level in that idea. And then you have to obviously fine tune and manage your entries and how long you hold that trade. So some good stuff today. I think that's a really important one for you to consider, to have a multi-asset approach to trading. Obviously, my love, my boot camp, my 30-day boot camp, and everything I do is Stock Trading Pro. But we do mention this once in a while, and there's certain situations when it does make sense. I do believe that limiting yourself to only one of them can be challenging. Nothing wrong with it. Don't write me hate mail. But that to me is that's the approach that I like to use. I feel it's a great way of taking advantage of different ways that the market is trading and really keeping your capital working in a way that matches the best available opportunities in the market. And that last thing that we just covered is super important, because it will keep you out of mediocre trades, help you manage your risk and leverage, and help you manage your profit opportunities to both scale up and scale down, quite honestly, depending on when you look to the left and see how much money was committed to those ideas. So that's Stocks for Breakfast Tuesday, May 19th, 2020. Thank you so much for the well wishes on my wedding, and I'll see you soon. Have a great day, everybody.